Okay, I am delighted to welcome back Graeme Carson from Cyan Investment Management to the Fund Manager interview series. Graeme, how are you?
Very well, thanks, Mark. Thanks for having me back.
Yeah, good to have you back. For anybody who mightn't have come across Cyan Investment Management, do you want to just give us a quick overview of the fund and what kind of companies you're kind of looking to invest in as part of the strategy?
Yeah, sure. So we established Cyan around 2014. I own the business with my business partner, Dean Fergie. Very much a focus on growth companies in the emerging company space in ASX listed or soon to be listed area of the market. We hold around 25 to 30 positions at any one time, ranging in market cap from 50 million up to say 500 million. So a diversified portfolio. The sectors of focus include industrials, consumers, some tech and fintech and healthcare. Where we don't go is biotech, oil resources or property. So very much a long-term focus, fundamentally research-driven approach. We're happy to be one of the first instos on a register. We do have a portion of the portfolio that is revenue generating but not yet profitable, but the vast majority are profitable businesses, but still relatively early in their sort of growth life cycle phase.
Okay. And the first business we're going to talk about this morning, newly listed, but I think it fits into that latter half of the portfolio, growing, profitable, even though it might only be on the boards. I think it listed, this month last year, I think so. It's just had its 12-month birthday, and that's Fliz Logistics. So for anybody who hasn't kind of come across the business, maybe just give us a quick snapshot on how these guys make their money.
Yeah, sure. So Fliz Logistics, code SLH, it's got a market cap of about 180 mil. As you said, listed last July. The issue price was around $2. We invested in IPO and have since added. It's trading around $2.25 at the moment, which, considering how small caps have performed over the last 12 months, it's been exceptional, certainly on a relative basis. So obviously it's a logistics business, provides logistics services. Don't think big, heavy asset-based balance sheet, traditional logistics business. This is a business that very much operates full outsourced services for specialty areas outside that big, bulk, low margin part of the market that's dominated by the biggest competitors. So they've got a footprint in Australia. It's a domestic business, pretty much a national footprint, although that is going to be expanded in terms of breadth and depth over the next couple of years. Victoria is still the dominant contributor, but it is building out a national business. It's already sizable. It writes about 375 mil in revenue through its two main divisions, one of which is port logistics, which is about 2/3 of the revenue. So think road transport to and from the wharfs, packing and unpacking of containers, things like that. So the number of containers handled is one of the key metrics there in terms of volume. The second part is contract logistics, around 1/3 of their revenue. So I think more warehousing of products and then distribution of that products. And their customers are generally fast-moving consumer goods businesses, specialty retail, some agri, and some sort of light industrial.
Okay. And the key, I guess, kind of investment thesis, why you guys invested in it, is it that kind of national expansion footprint, and then just the customer base that then attracts? Because I know a lot of businesses, especially these FMCG businesses, where the product is pretty universal in terms of can sell it in Sydney, Perth, Melbourne, Brisbane, it doesn't matter, but they do like to work with people who have that national footprint rather than dealing with an East Coast based logistics provider and then somebody doing maybe South Australian part for them.
Yeah, look, absolutely. That's certainly part of the thesis. There's actually, in our opinion, this is a portfolio that sits really well in a long-term. A company that sits well in a long-term investment portfolio. It's got all of the elements of what a good micro small cap should be. So it's got proven management firstly. the business was established back in 2013 or 14 through an MBO, a management buyout, and those guys are still running the business, so they're a very safe pair of hands operationally. They've also proven their ability to grow the business, both organically and by acquisition. So back then it was doing about 90 million revenue. It's now doing, as I've said, 370 million plus, and around 2/3 of that has been driven through organic growth and the rest through acquisition. So it is a genuine growth business. It's also very profitable, and it'll do about 16 million in profit this year, growing to over 20, we think, next year. And it's got a good balance sheet capacity to continue funding growth, both organically and acquisition. It's still relatively ungeared. It was net cash until it made a recent acquisition of about 30 million, but certainly still a lot of headroom there. So it's got a good management team, it's profitable, it's got a good balance sheet, and it's operating in a market that's still very fragmented. So it can grow that national footprint comfortably. We don't think aggressively, but it'll do it over time, which will end up in sort of expanded margins. So for business with all those attributes, we think it's really well priced, which is the main part of the thesis. We think it's a high quality business, but in the past you've had to pay a lot for these types of businesses, but the current environment's presented some opportunities that we think are pretty rare, and this is one of them. So you're paying 1 year forward, so fiscal year 23, you're paying a PE ratio of around 8 to 9 times, so single digit, with a yield that's fully franked of 5 to 6% per annum. Now, the reason we think that the growth and valuation will come through is because this is a very asset-light business. So they don't own property, they don't own a great deal of equipment. It's more of a lease and rent model. But because of that, they get a very high return on capital. So when I spoke about the yield before, the dividends of 5 to 6%, that represents about half of the profit of the business being paid out to investors every year. So the other half effectively gets reinvested in the business at very high rates of return. So even at the equity line, the return could be about 30%, we think, on new capital deployed back into the business. So that gives you this compound earnings growth and big growth in valuation. So that we bought, the stock at $2, trading at $2.25. We think it's comfortably worth over $5 in the next couple of years, next 2 to 3 years, as the earnings growth comes through. So it's got all the attributes that we would look for in a small cap.
And in terms of, I guess, if we flip on to the other side of the coin, risks with the business, is it, obviously you said, some of their growth is coming through acquisition, so, that churns up its own kind of set of risks. Global supply chain disruption, inflation, affect a potential recession. We'll see what the treasurer says tomorrow. Is it, these businesses, I know from past experience, can be highly cyclical, depending on what the economy is doing. As you said, it's all about like kind of getting pallets in and out, containers in and out. Is that kind of one of the key risks, the kind of macro environment that it finds itself in?
Look, I mean, without doubt, as the whole industry does. So no matter where you're looking, certainly in logistics, they all face these risks. To an extent, these guys have only had a young listed life as well, so we don't have a great track record to work with, even though we've seen their business from afar for a few years. In terms of releasing official numbers, we've only got 1 year, so you have to be mindful of that. And yes, they are facing wages pressure and cost inflation. We've got logistics supply issues. So time will tell how much that'll bite. I mean, they have proven that they can deliver good returns and results through COVID, which I thought was pretty impressive. So that's one thing. And yes, the acquisition side of it is also a risk. They do bolt-ons rather than big company making acquisitions, generally speaking. And the asset-light business model means they're not in complete control of certain aspects of the business. If they need to scale it up, they have to access people and equipment. But look, all those things are, risk in most businesses at the moment, other than the asset play. And that's, I think, when you're paying single-digit multiple with income along the way, on a risk-return basis, I think it still makes a lot of sense.
And I mean, reporting season is just around the corner. So in terms of things you're going to be looking out for in the result, maybe, give us two or three key points that you're going to be focusing on? Obviously, you mentioned the containers through the port handling business is one of the key metrics to look at, and growth in that, and maybe commentary on the outlook for that now that hopefully supply chains globally are starting to normalize. I see the prices for shipping containers is coming down a lot, so hopefully that spurs demand on again. It makes it more cost competitive to actually ship stuff. But maybe just give us a few points on what to watch out for in this next result from them.
Yeah, look, I mean, that's your point there about supply chains opening up is going to be one of the key messages. So anecdotally, we're all hearing things like you said about container costs reducing. I think they've been reducing materially since about February this year. So long may that continue, hopefully. Still geopolitical risks out there as well. But if you look at the first half result, they did beat expectations at the top line of the margin. They increased guidance for the second half, which they're about to report on the 25th of August. So we'll be looking more for the margin performance in the port logistics business, and then some of the growth and how the acquisitions are performing as well. So that's one thing we'll be looking at. And then secondly, beyond that, outside the report itself, they will be making more bolt-on acquisitions as the one that we spoke of in WA, which is about a $30 million acquisition. So I think there's going to be some share price catalysts coming through. I'm confident the result will be very solid. I mean, I'm very wary about, as management would be, about outlook statements. I think generally across reporting season, I think management will be pretty non-committal because of all the uncertainty out there. So I don't expect any real clear guidance, but but time will tell.
Yeah. Okay, certainly an interesting one to keep an eye on. And yeah, as you say, they haven't been listed for too long, so maybe one to put on the watch list that people haven't picked up on their results to date. And then the second one, I think, is one maybe a bit more familiar to our audience, is Pureprofile. Martin Fliz, the CEO, I think, has presented, I think, 3 times maybe over the last 18 months in our Coffee Microcaps Morning Meeting. But for anybody who mightn't be familiar with Pureprofile or caught one of Martin's presentations, just give us a quick overview of the Pureprofile business.
Yeah, sure. So Pureprofile is at the smaller end of things we look at. It's capped at 55 mil or thereabouts. We've been invested for a year or so. I think we paid 3 to 3.2 cents a share. It's trading around 4.7 at the moment. Interestingly, when you talk about Martin, so we met Martin a couple of years ago, or 18 months ago, and he's done everything by way of delivery that he said he would. So we've got a fair bit of confidence in his ability. So what does the business do? It's a data and insights company. So it offers sort of products and services that help its clients, which are large multinational businesses and well-known names, such as Flybys and Rays, Trivago, companies like that, to better understand their own customers and to offer improved services and product positioning and marketing. So they do online surveys, they host online surveys on specific client types, industries and demographics. They do media campaigns for their clients. And they've also got a SaaS business, which is a platform-based solution for clients. Now it's been around since about 2000 under new management, Martin's directorship. It's very much in a turnaround phase, but he's delivering on everything he said. So it's already proven on the way, and it's going in the right direction. It's now got offices in 8 countries. Revenue is still dominated by Australia, but it's pushing into other markets very well.
And the investment thesis, is it a turnaround that's kind of in progress and proven itself, or have we kind of moved on to the next phase of, Martin's managed to steady the ship, he's turned around it, and now there's, quite I know from listening to his presentations, he's very bullish on growth, especially outside Australia and for the SaaS platform. So in that continuum, where do you see kind of the investment thesis for Pureprofile?
Yeah, I think you make a good point. I think we're past the fear-driven turnaround risk. The business in Australia, is big and working well. They've got a dominant market share, but they're pushing into the UK, which I think is 14 or 15 times bigger than the Australian market, and the US, which is about 40 times bigger. So they're already getting serious traction in the UK. And so in FY22, they'll do around, we think fundamentally it looks good too, they'll do around 42 mil in revenue this year. We expect in the upcoming result, which represents growth of around 40% year on year, and EBITDA of about 4 million, which is about 30% growth. So the Australian data and insights part of the business still represents about half the revenue and is still growing well. But other regions, like mostly in the UK, which is around 25% of revenue, is growing even quicker at about 50% year on year. So over the next 2 years, we expect revenue to grow organically at about 25% a year to 70 million, and margins to expand from 10% into the mid-20s or maybe push towards 30% at the EBITDA line. And they'll also make some bolt-on acquisitions, which they can do. They're net cash on the balance sheet. So there's real earnings upside here for us. Again, it comes back to what do you pay for these sorts of businesses, and again, this is what the opportunity is presented in the current environment. Given its growth profile with a PE of 10 or 11 times 23, it looks fundamentally cheap. There's no dividends in this one. It's all being invested back in the business for growth. But they're the fundamental reasons, and then there's probably a more broad macro reason, which is this move to reduce or remove third-party cookies from the data markets, which means that there'll be a trend back to first-party data requirement, which is very much in the sweet spot of where Pureprofile's positioning itself. So overall, the industry could grow really strongly.
Yeah, that cookies thing, I think it's, I can't remember, Martin did mention in one of the presentations, it's coming in, I think, 1 January 23 or 1 January 24. So it's definitely something that's going to happen. And I think, like all things, every corporate will leave it to lastminute.com, and then they'll suddenly wake up that their previous data sources have suddenly dried up or are about to dry up, and there'll be a scramble. But in terms of the risks, what are some of the risks that come with Pureprofile? Is it, I think anybody who's followed Australian companies for any length of time will know about horrendous overseas excursions that have blown up spectacularly in many cases from the top of the market to the bottom. So I mean, that brings its own concerns. What else should kind of we be aware of on the risk side of the equation?
Yeah, look, I think that's the main one, the push into offshore markets. As I said, they're genuinely penetrated now in the UK, which represents 10 million revenue or whatever it is. And the US, it's a very measured approach in specific verticals that we're expecting, although it's very early days there, but that's obviously a risk. Martin is English, and he has worked for large incumbents in the industry, so he knows the industry well. He knows it on a global scale. So I think he's a safe pair of hands in that sense, but there's always risk with execution. And then, of course, there's bolt-on acquisitions. Now, historically, acquisitions haven't gone well for this business, but that wasn't under Martin's control. So I think himself and Mr. CFO will do a much more conservative and measured job there. But they're probably the two main ones. And then, of course, with any business that's writing this sort of revenue, and it's substantial now, you're growing off a higher base. And as you do that, you're trying to get bigger multinational clients, and you're competing against incumbents in there that are probably well funded, and you might get a competitive pushback or response. So that's probably another thing to consider, I'd suggest.
And then, as far as I remember, there's still Appendix 4C reporting Pureprofile. So, when we see that, and we get maybe a bit more color when the result comes out in August, in terms of maybe an outlook statement that they'll be kind of maybe 2 months into the start of this year. And they've guided pretty well, I think, on kind of what they're expecting. I think they released guidance maybe a month ago or so. So what are you is it more the outlook statement we should keep an eye on now at this next result, and when the 4C comes?
Look, outlook statements, as I said previously, are going to be an interesting talking point in the upcoming result. But firstly, yes, they have guided to the revenue and EBITDA line, so we shouldn't get any surprises there. I think guidance is probably more likely to come potentially around AGM time for a lot of these microcap companies, when they get a good look at that first quarter and check that momentum's still there, and do a bit of a heat test on the economy. So I don't expect too much. I just think this is more of a now, let the momentum build, let them do their thing. They will make bolt-on acquisitions. So whether that comes in the next few months or not, we don't know. And then it's going to be just the measured push into offshore markets and gaining traction there. I don't see this as a strong catalyst-driven play where big announcements are going to push this, really, really aggressively. I think it's more build trust with investors, and then it will just grow over time. There's a lot of operating leverage in it. So, I mean, we see this value that it's trading at just under 5 cents. We see this value comfortably over 10 cents.
Okay. Graeme, thanks for that. I think we got two interesting companies. I think one probably a bit off the radar for most people, and one that might be more familiar in Pureprofile. And we'll definitely keep an eye on the results over the next couple of weeks. Thanks very much for joining us once again, and hopefully we can touch base maybe in a couple of months' time.
Yeah, absolutely, Mark. Thanks for having me.